Have you ever wondered why the price of that cool gadget from overseas keeps bouncing around, or why your dream vacation suddenly costs more or maybe less? The secret? It all comes down to exchange rates. And today, we're going to pull back the curtain on how it all works.
So, let's kick things off with a real-world puzzle. Picture this. You're in Mexico, you find the greatest taco of your life, and it costs you $2. Awesome. But you go back a year later, same taco stand, same price in pesos, but now it costs you $3. So, what gives? That, my friends, is the power of exchange rates in action. So here's our game plan. We're going to start in the huge global marketplace where money gets traded. Then we'll dig into why these currency values are always on the move. After that, we'll see how these changes actually hit your wallet and the whole economy. And finally, we'll check out the high-stakes strategies governments use to try and control it all. Okay, let's dive right in. To really get a handle on exchange rates, you got to go to the source, a massive worldwide market that's all about one thing: money. Now, this isn't some building you can go visit. The foreign exchange market, or Forex for short, is more like a giant, invisible web connecting banks, big companies, even individuals, all swapping currencies 24/7. And it's this constant, non-stop dance of buying and selling that sets the price of one currency in terms of another. That price is the exchange rate.
So, who's actually playing in this market? Well, you might be surprised. It's pretty much everyone on the global stage. You've got companies buying parts from other countries, you've got travelers like you and me swapping dollars for euros for a trip, and you have huge investors moving billions with a single click. Even governments get in on the action.
Okay, so if it's a market, that means prices, the exchange rates, are always changing. But what's actually making them move? Well, it all boils down to the most classic idea in economics: supply and demand. All right, let's tackle demand first. Think about the US dollar. The demand for it comes from anyone outside the US who needs to get their hands on some dollars. And why would they need them? All sorts of reasons: to buy American products, to invest in the US stock market, or hey, even just to visit Times Square. So what makes a currency like the US dollar suddenly become super popular? Well, a few key things. If US interest rates go up, global investors want in on that better return, so they'll demand more dollars. If the US economy feels like a safe bet in a shaky world, people will buy dollars to park their money. And of course, if the next big tech gadget from a US company is a hit, everyone needs dollars to buy it. And you can see this in action right here. When the US decides to bump up its interest rates, look what happens. Boom. The demand for the dollar shoots up as investors from all over the world rush in to get a piece of that action. So the bottom line here is super simple. When more people want a currency, its price goes up. And in the world of finance, we call that strengthening or appreciating. The dollar is now more valuable, meaning it's going to cost you more yen or euros or pesos to buy a single one. Okay, that's demand. Now let's flip it and talk about the other side of the coin: supply. The supply of a currency is created by people who have it and want to trade it for something else. For example, if an American wants to buy a German car, they are supplying US dollars to the market to get the euros they need. And this just nails the concept. Imagine tons of Americans suddenly get the travel bug and decide they absolutely have to see Paris. They start selling off their dollars to buy euros. Suddenly, the market is flooded with US dollars. And just like anything, when there's too much of it, its value drops. We call that weakening or depreciating. All right, so we've got the theory down: supply and demand. It's a little abstract, right? Well, now let's talk about why you should actually care. We're going to see how all this big market stuff actually hits you, your wallet, and yep, the entire national economy. So let's just imagine a scenario. Let's say the US dollar gets really strong. It appreciates compared to, say, the euro. What does that actually mean for everyday life? This table lays it all out perfectly. If you're an American, a strong dollar can be fantastic. That trip to Italy, suddenly cheaper. That imported car you've been eyeing, the price might just drop. But, and this is a huge but, it's not good news for everyone. If you're an American company trying to sell your products in France, you've got a problem. Your stuff is now more expensive for them to buy. And look, this isn't just about one vacation or one car. We're talking about a huge ripple effect. On a national level, a strong dollar means we tend to buy more from other countries and sell less to them. That can really hurt our export industries and the jobs that go with them. It can actually act like a brake on the entire economy. So when you see these massive consequences for the whole economy, you have to ask the question: do governments just sit back and let the market run wild?
Or do they try to step in and grab the steering wheel?
Well, they really have two main playbooks. On one side, you have a floating exchange rate. This is where the government mostly lets the market, supply and demand, do its thing and set the price. That's what the US does. On the other side, you have a fixed or pegged rate. This is where a government says, nope, our currency is going to be worth exactly this much, and they lock it to another major currency. Now, trying to fix a currency's value is a constant battle. If the market starts pushing the value down, the country's central bank has to jump in and start buying up its own currency using its stash of foreign money. If the value gets too high, they have to do the opposite and sell their own currency to push the value back down.
But like pretty much everything in economics, there is no magic bullet here. Choosing between a floating rate and a fixed one involves some really tough trade-offs. It's a classic showdown between stability and flexibility. The best thing about a floating rate is its adaptability. It acts like a natural shock absorber for the economy. It also frees up a country to focus on its own problems, like inflation or unemployment. The catch? That flexibility can create a ton of volatility, making things really uncertain and unpredictable for businesses. Now, on the flip side, a fixed rate offers something businesses absolutely love: stability, certainty. But here is the massive trade-off. To keep that peg, a country basically has to give up control over its own domestic monetary policy. They have to do whatever it takes to defend that rate, even if it hurts their own economy in the short term. And that brings us to the ultimate question. In today's turbulent, unpredictable global economy, what's better? The solid, predictable anchor of a fixed rate or the nimble, flexible shock absorber of a floating one? There is no easy answer, and it's a debate that literally shapes the economic destiny of nations.